Welcome back to Investing Talk Podcast.
Today we're looking at SoundHound AI.
As usual, before we start, subscribe, like, and comment to this video to support the show. And if there's a specific company you want us to look into, leave in the comments below.
So let's get into the analysis. Their Q3 2025 performance really jumps off the page. The word is acceleration.
You can say that again. It's hard to ignore those top-line numbers.
Sure.
For the quarter, SoundHound AI reported a record, was it $42.05 million in revenue?
And that's a 68% increase over the same quarter last year. A huge jump.
But it's not just a one-off good quarter, is it?
Not at all. I mean, if you zoom out and look at the whole year so far, the first 9 months revenue is up 127%.
Wow.
That kind of velocity is why management felt confident enough to raise their full-year guidance pretty substantially. Yeah. They're now projecting between 165 and 180 million for 2025.
That's a strong signal. And the market seemed to like the earnings picture, too. The non-GAAP numbers were much better than expected.
Much better. The non-GAAP net loss was only 3 cents a share. I think analysts were expecting something closer to 9 cents, so they beat that by a mile.
But the really interesting story here, I think, is where that revenue is actually coming from. It's not the old business model.
Exactly. The mix is shifting fast. The real engine here is service subscriptions. That segment just soared.
It was up 78% in the quarter alone.
And 245% year-to-date. That's where the growth is, mostly in the Americas.
So what about the more traditional side, the product royalties?
Well, that's the thing. It's still growing up 34% in Q3, but it's basically flat for the year so far.
So that tells you everything about the strategy, right? The value isn't just getting the tech into a device anymore.
It's all about the recurring subscription revenue that comes from the services built on top of it. That's the long-term play.
And that ties right into how they're positioning themselves against, the giants, the Googles and Amazons of the world.
They're very deliberately the independent choice.
Their whole pitch is, we provide the AI, but you keep control of your brand.
You keep control of your data, you customize the experience. You aren't just handing your customer over to a third-party ecosystem.
And that's a huge deal for a lot of companies. Plus, they have the tech to back it up, right? The whole edge and hybrid capability.
Yes, meaning the AI can run locally on the device. It doesn't always need a cloud connection. For industries like auto or healthcare, that kind of privacy and reliability is it's non-negotiable.
And this massive growth we're seeing, it's not just organic. It's being fueled by a really aggressive acquisition strategy.
Oh, absolutely. The most recent big one was Interactions, which closed back in September.
And that was a play to become the leader in what they call agentic AI.
Right. And just to clarify for everyone, agentic AI isn't just about answering a question. It's about the AI proactively taking complex multi-step actions on your behalf, like a truly autonomous assistant.
And buying Interactions was like a shortcut into that market.
Yeah, a huge shortcut. It instantly brought in major enterprise clients. We're talking Fortune 100 companies in insurance, auto. It just fast-tracked their entry into high-value customer service.
And you can see the results of all these acquisitions, Interactions, Amelia, SYN Q3. You can see it in the new deals they're announcing.
You really can. Look at restaurants. They're not just running pilots anymore.
No, this is full deployment of AI ordering with huge chains like MOD Pizza, Red Lobster, Torchy's Tacos.
This is solving real-world problems.
Yeah.
Labor shortages, order accuracy during the dinner rush. It's proven itself out.
Then you've got automotive, which is just on fire for them.
A deal with a huge global sports car brand for a custom voice personality.
Rolling out chat AI in Jeeps all across Europe.
And it's global, too. Deals for two-wheelers in India, a massive deal in China for tens of millions of smart devices. They're everywhere.
This all ties back to their three-pillar model for making money.
It does. So pillar one is what we talked about, the product royalties. The one-time fee to get the AI into a product.
Pillar two is the big one now, service subscriptions. That's all the recurring revenue from food ordering and customer service.
That's the growth engine. And then there's pillar three, which is called monetization.
Which is tiny right now, right? Just add revenue from a music app.
For now, yes.
Yeah.
But the long-term vision is for it to grow meaningfully. And this is where their big idea comes in.
The monetization flywheel.
Exactly. The flywheel.
So walk us through the scenario. How does this actually work?
Okay, so picture this. You're in your car, which has SoundHound's voice AI built in. That's pillar one.
Got it.
You say, I want to order from Red Lobster. The restaurant also uses their voice AI for ordering. That's pillar two.
Right.
When you place that order through your car, a transaction happens. And a small piece of that transaction revenue gets shared back with the car maker.
Ah, okay. So the car company suddenly sees voice AI not as a cost, but as a potential revenue stream.
Precisely. It totally flips the incentive. The automaker is now encouraged to get people to use the platform for commerce, which feeds the whole ecosystem. It's a very clever, self-reinforcing loop.
That does sound like the future. But building an empire like that, especially through acquisitions, takes a lot of cash. So how's the balance sheet looking?
Well, let's pivot there because on the surface, it looks incredibly strong. As of the end of the quarter, they were sitting on about $269 million in cash.
And maybe more importantly, zero debt.
Yeah, that's a huge point of pride for them. They paid everything off, the term loan, the debt from the Amelia acquisition. It shows real financial discipline.
It does, but you have to look at how they got that cash, right? It wasn't all from operations.
No, they raised about $201 million so far this year through their ATM program.
The at-the-market program, which is basically just issuing new shares into the market to raise capital.
It is. And while it gives them a ton of flexibility and lets them be debt-free, it comes at the cost of shareholder dilution. It's a classic trade-off for a high-growth company.
And they're putting that money to work. R&D spending is way up.
Up 46% year-to-date, just on personnel. They are investing heavily in their generative AI models and rolling out all those new services we talked about.
Okay, so let's get into some of the complexities here, the things you don't see in the headlines, starting with gross margin.
Right. Because while revenue is soaring, the GAAP gross margin actually went down. It fell from about 48% last year to under 43% this quarter.
That's a pretty big drop. What's causing that compression?
It's a direct result of the acquisition strategy. It's the amortization expense from all the intangible assets they bought.
Things like the developed technology from Amelia and Interactions.
Exactly. It's a heavy non-cash accounting charge that hits their cost of revenues every single quarter.
But if you strip that out?
If you look at the non-GAAP gross margin, it's actually very stable and healthy. It's sitting around 59%. So the core business is profitable, but the accounting for the acquisitions makes the GAAP number look worse.
Speaking of GAAP numbers looking strange, we have to talk about the elephant in the room. That massive GAAP net loss of over $100 million.
$109 million, yeah. It looks terrifying if you don't know what's behind it.
So what is behind it? It's not a cash loss.
No, not at all. The biggest piece of it, about $66 million, was a loss from the change in fair value of contingent acquisition liabilities.
Okay, in plain English.
It's the earnouts. They owe future shares to the former owners of Amelia and Interactions if those businesses hit certain revenue targets.
Okay.
Because SoundHound's stock price went up during the quarter, the dollar value of the shares they might have to issue in the future also went up. Accounting rules make them book that increase as a loss today.
So they're literally booking a loss because their stock performed well.
It's completely counterintuitive. It's a financial penalty for a successful quarter. It's just non-operating noise, but it really distorts the bottom line.
That's a crucial detail. But there's another issue that feels a lot more operational, a lot more serious.
Yes. Management's own conclusion that their internal controls over financial reporting were not effective.
That is a major red flag for any public company.
It's a critical risk. They cited material weaknesses in oversight, in segregation of duties, and specifically in handling complex transactions.
Like, say, acquisitions.
Exactly like acquisitions. They even admit these failures led to errors and risings in the past. When you're trying to integrate 3 huge different businesses at once, weak controls are a recipe for disaster.
So they have a plan to fix it.
They say remediation is underway. They're centralizing payroll, consolidating CRM systems, things like that. But the weaknesses are still there, and investors need to watch that very, very closely.
And on top of all that, there's just the background noise of ongoing lawsuits.
A patent complaint, a securities class action. While they can't estimate any potential loss, it's a cost and, frankly, a distraction for management.
Okay, so let's try to synthesize all this. On one hand, you have a company that's executing this incredibly aggressive M&A strategy.
It's working, too. You see it in the massive revenue growth and their really strong zero-debt cash position. They've clearly carved out a niche as the independent player.
But on the other hand, the cost of that growth is showing up, both in the accounting noise and in the real compression of their GAAP gross margin.
And, more importantly, in the serious operational challenges. The internal control failures are not something you can just ignore. That has to be fixed for them to scale properly.
If you want more cutting-edge analysis like this, be sure to hit that subscribe button. Before we close, consider this final provocative thought. SoundHound AI has successfully paid off its debt and raised cash, demonstrating faith from the markets. But the future trajectory hinges entirely on whether they can achieve the ambitious revenue targets they have deemed probable for the Amelia and Interactions earnouts over the next 2 fiscal years. Can this rapidly assembled empire integrate into a single, cohesive, and profitable platform while simultaneously fixing their underlying operational controls? That is the billion-dollar question.